Good afternoon, everyone. My name is Richard Brass, and I head up Wealth and Asset Management UK at Berenberg. I'm delighted to welcome you here today, and we're really enjoying working with David and the PCD team. As some of you may know, or many may not, we are a specialist in the equity space. On the investment banking side, we have a significant equity research business, and in our investment world, we have at the cornerstone of many of our strategies an institutional group of stock pickers that specialize across the all cap space globally. Peter heads up the small and micro cap team. He's been specializing in this area for his entire career. He's got a tremendous track record and a fabulous array of stories and anecdotes of companies that he's invested in over the years. We're delighted that he can join us today and share some of those stories and experiences with you. Please do not hesitate to ask him any questions you like. We see this area of expertise as critical, both for offering distinct investment strategies for clients, as well as composing broader multi-asset or all equity strategies, whereby having access to small and micro cap fields gives us areas of diversification and different types of return profiles. And these are areas which we believe will continue to deliver strong performance and outperformance for our clients, whether they're traditional private client wealth, all the way through to the institutional wholesale space that we also work with. So enjoy the afternoon, and I look forward to speaking to some of you in due course. Over to you, David.
I'm delighted to be speaking today with Peter Kraus. We're going to discuss over the next 40 minutes Peter's views on the European small cap space, part of his investment philosophy, and how he runs his fund at Berenberg. So welcome, Peter.
Welcome, David. Thank you.
So just to start the conversation today, Peter, it would be great to hear a little bit more about your background and your interest, your passionate interest in this small cap space.
Yeah, as you said, David, passion is my hobby. I've turned my hobby into my profession. I've spent all my life basically in capital markets, equity research, portfolio management, and I've been in different institutions, well-known institutions, and I'm part of a very motivated, talented team at Berenberg. We started in October 2017. Most of us, or a good part of us, come from Allianz Global Investors, like myself, more than 10 years. Some from DWS, Goldman Sachs, and some very younger, talented people we're raising into the teams.
Thank you. So there's a terrific pedigree there to the team that you've just set out. Your fund has returned 76.6% in the last 3 years, compared with the sector average of 30.9%. I mean, what do you attribute the success of your approach to be down to?
Oh, it's a combination of various factors, David. It's first of all our experience. I've been doing that all my life, as I said. So we've known the universe, the industry for more than 20 years. Then it's our entrepreneurial thinking, I would say. We're never satisfied. There's always more to go for. And our passion. And I think we know where we have to look for the future leaders, where we can participate in supernatural returns for the next 5 or 10 years.
And how do you find these new companies to invest in? And in these times of COVID, has that changed the way that you had to conduct that process, with company visits being less available? But on the other hand, senior executives, have they been more available because of less travel? How do you create your process, and how has that been impacted through COVID?
Good question, David. To be perfectly honest with you, nothing really changed. I mean, we have been working independently of location and time, more or less, before. Now it accelerated. Nobody knew what's going to happen. But we're using all kinds of technologies to liaise within the teams. And remember, David, we're a very small and pragmatic teams. My team, we're 5 people connected more or less 24/7. And there has been basically no big change. We've done video and telephone before, of course. Corporate traveling, that has been restricted. Whether it will come back, we'll see to a lower extent maybe. But we do not reduce our corporate access activities at all. Maybe the opposite. So we are really close to the founders, to the managers, to the leaders of our holdings. We can get meetings with all of them almost instantly if we want. And so we are really well connected. As I said, we've known them for many years. We accompany them. So basically, COVID didn't really change our corporate access abilities. And from a maybe portfolio structure, it didn't really impact the portfolio from a structural point of view, but I think we're elaborating on that in a second.
Do new companies that come onto your horizon, do they come out of your existing network? As you said, you know your sectors in detail, so there's no surprises in terms of new companies emerging. It always comes out of a good company that you're already mapping through your analysis. Is that right, or do sometimes companies come out of left field that you weren't expecting to be monitoring?
Some or most investors are surprised if I tell them that we are dealing with more than 7,000 companies in Europe. And maybe you're surprised as well if I tell you the US market is below 4,000. So the European universe, in terms of number of listed stocks, is roughly twice as large as the US. So our hunting ground, if you want to call it like that, hunting ground is huge. And we're constantly monitoring it. There's, of course, a lot of IPOs, spin-offs, some M&A, so it's very vibrant and it's moving. So we have to be very close and aware of new issues. We look at everything, but honestly, IPOs are, sometimes they are good IPOs for sure, but we're not subscribing to any IPO. We have a very sticky portfolio approach. We are disciplined. We do not turn over the portfolio so much. So there's a lot of companies in the portfolio today which we have owned maybe 5 or 10 years ago already. And so the good ones stay good. The bad ones usually don't improve. That's the philosophy behind it. And of course, sometimes we do mistakes. It's quite natural. We overlook something. Then maybe a few years later, it pops up again, and we're buying at higher prices. If we think it's not too late, on the opposite, we're not too proud of cutting losses, and we're selling with losses sometimes. It's not happening so often, but we have to be flexible. The future is uncertain, and we have to be quite close to the trends. But we've known these good companies for 10 or 20 years, and we are really sticky with them. We're not irritated by 1 or 2 weak quarters. So it's not that we have to find new companies every day, but we are well connected in the industry across Europe.
You mentioned there the number of stocks across Europe and the lack of research coverage in some ways of some of those European stocks. So does that create an advantage for you covering them for investors, because you can actually unlock a lot of value there?
Yes, it does indeed. Maybe you're surprised. The microcap universe is, we call it below 500 million euros in market cap. It's around 5,000 companies. And guess what the median coverage is from a sell-side analyst? The number is surprisingly low. It's 1. You can, what does it mean? Half of it, so 2,500 companies are not covered by anyone except for maybe the CEO and the founders. And indeed, for most investors, it's a high barrier to entry to get information. They are maybe slow, maybe there's a little bit of laziness in the industry here and there, but we think differently. It's a huge opportunity if nobody has digged deeper before, except for the insiders, so the corporate insiders, the founders, the managers, some family and friends, investors. And historically, in our microcap fund, we have been really early. There are some, or quite a lot of examples where we have been one or even the first investor outside of the local community. And basically these hidden champions, we call them, or innovation leaders in small niches. You find them. You have to dig deep. Sometimes you have to translate local languages into English in Finland or France. So we're fluent in German and English and a bit of French, a colleague of mine, but we cannot do all languages. So we're translating. So, but that's a lot of entry barriers to gather information with a small market cap stocks. But again, for us, it's a big opportunity if we see there is a lack of coverage, because these companies are quite strong sometimes, and the valuation of them, because there's no official coverage, is sometimes extremely attractive. But you have to find them. You have to know how to approach them, how to deal with them. And we've done that for 2 decades now. So we have a little bit of experience, I would say.
Okay, thanks. And you've written previously about healthcare companies such as Biotage in Sweden and Revenio in Finland. I'm not sure if I'm pronouncing those right, but perhaps you could explain a little bit about these companies and why they represent exciting opportunities for investors.
Actually, both of them fulfill everything I just mentioned. Both of them, Revenio is 1.7 billion euro market cap, and Biotage is 1.1, 1.2. So decent size, not so small anymore, but still neglected. I mean, it's not one of the bigger healthcare companies like Coloplast with, I don't know, 10 analysts. There are 1, 2, 3 analysts on the stock, but both of them I discovered 10 years ago, roughly, plus minus 8, 9, 10 years ago. They were both around 200 million. Insider holdings, founders, managers, no analysts on the stock, so completely neglected. But their business was extremely interesting and attractive back then. I mean, Biotage is one of the leading global separation, they call it separation technology companies in pharmaceuticals, in diagnostics, in industrial processes. Their market share is 30, 40, even % globally in some niches. And they're growing around 10%. When I met them, the operating margin was really low, 5%. Now it's 26. Balance sheet is net cash, and they're growing double digit. And if you look at the big medtech or healthcare companies in Europe, some of them are really good, but they grow maybe 5%, but not 10 or 15. Similarly, or even more extreme in the case of Revenio, they call themselves a health technology company where they can detect glaucoma with a fully digital device. You can I've tried it a few times. You can just measure your eye pressure with a high-tech device, which is a small needle touching the surface of your eye. And it sounds strange, but you don't feel it because it's so thin. It's a consumables business, fully digital. It's stored into your whatever you use, iPhone, and in the cloud. And they have a leading edge in that technology. Basically, there's no real competitor. And they have grown more than 20% over the last 5 years. And when I met them, it was equally attractive because it was a niche. The products have been approved, patented, global sales. Now they're much bigger. But what has been underestimated with both companies is the compounding effect. If you grow like 10 years, 10, 15, 20%, you can do the math, 1.2 to the power of 10. It looks like a J, basically. And there is a tendency of caution from investors and from analysts. Not that we are overconfident, but we have a clear view on where these companies can be maybe in 5 or 10 years. And usually after 1 or 2 years of supernatural growth, the growth rates are modeled in the analyst model to be much lower. but in these cases, they even accelerated their growth. And the operating margins, they went up from single digit to high double digit. And basically, yeah, the valuation multiple, last but not least, was up from maybe 10 times to 30 or 40 times. So then you get these big performance drivers, but you have to stay tuned. There were so many opportunities in the last 10 years to leave these stocks, to get out, to be squeezed out after 1 or 2 weak quarters. Then you would have lost the nice part of the journey. And we looked through these temporary slowdowns, and we have been in there for 10 years.
And with these companies, do you instantly kind of get a feeling in that meeting that this is a good company, it has the look of a good company, or does it take a lot of time to kind of gather your views and to get to know the management team, and or in some cases is it very instantly apparent where you're finding that bit of gold straight away?
It sounds easier than it is, David, but I mean, two answers to that question. First of all, everything that is binary, black box type of business model, make or break, highly complex businesses, we leave to others. We are happy to offer that to others. We're not traders, not speculators, no make or break type of biotech profiles, steady Eddie, high quality. And if you do your work before, we're looking at the, let's say, 10-year track record, growth, margins, cash generation, capital returns, and balance sheet. And if it screens well on the paper, then we approach the management for a meeting. And usually it's no surprise if you get a company with double-digit growth for 10 years and all these KPIs I've just mentioned. It's no surprise to see that the CEO is quite an entrepreneurial spirit, and usually these are great managers. And in more than not, or in many cases, the financials are confirmed by the interaction with the management. It's not a surprise that it's people behind good businesses.
Okay, thanks. And we talked a little bit there about a couple of companies from the healthcare sector, but which other sectors do you think are well set for solid returns as we come out of the pandemic?
As I said before, David, we haven't changed the structure of the portfolio because of the pandemic. We have always been significantly overweight in sectors like, as you mentioned, healthcare. But healthcare is not drug development. It's like the two companies you've mentioned, very stable, high margin type of business with high visibility. So no biotech profiles. Then we have a technology, industrials, and consumer. Everything else, usually we are not at all present. So we don't own banks, insurance companies, real estate, telecoms, utilities, mining type of businesses or energy businesses. Why? They are most of them have weak balance sheets, low growth, high degree of competition, low gross margins, and weak shareholder value generation, basically. But there are always interruptions on these long-term trends. Like the last 6 to 9 months, there is more than ever before talk about value versus growth, cyclical versus defensives, low quality versus high quality. There was a huge recovery in the market, in the position, in the expectations. And that is usually a headwind for us, because all these distressed type of assets like Italian banks or French shopping centers, UK supermarkets with very weak balance sheets. So there are some positive exceptions. Of course, not everything is in a bad shape, but these have all in common that they are not the, let's say, innovation leaders of the next 10 years with double-digit growth and 20% operating margin. But these phases come and go. We've seen that so many times over the last more than 20 years. And how do we deal with it? That is a temporary headwind where our performance is temporarily a little bit weaker, like in the last 6 to 9 months. we basically have not outperformed, but we haven't underperformed either. So we've done the homework before. We've done some adjustments last year because we've seen the recovery. The market has discounted it rightly, but we're happy with the position. We don't steer the portfolio because of a 6 months recovery so much.
Certainly. And ESG and sustainable investing is something that a lot is written about in the financial press. How do you see the taste for ESG and sustainable investing fitting with a small cap investing approach?
Actually, we've done that before. We have always recognized the principle of ESG. Even before, I think when we started to look at it, there was no one telling us ESG, 3 letters. I think they didn't even exist, but I think every sensible analyst or portfolio manager should incorporate it to a certain extent, not overdo it maybe. We're not a dedicated ESG portfolio, but we recognize the principles, meaning corporate governance is very important. We're not investing in businesses where the top management has no skin in the game. If you don't own equity, usually that doesn't leave a good impression for incentives. Yeah. So as we own our own funds, so we have the same philosophy. We cannot trade single micro or small cap stocks because of compliance reasons. We want to be fully aligned with our clients. So we own our funds. So we require the top management to own the business themselves to a certain extent, of course. And environment, if you recall the sectors I've mentioned, we're not investing in these environmentally destructive type of businesses in Latin America or some diamond mines in Botswana or anything like that. We're completely out, no weapons and stuff like that. That goes without saying. And we're not into these emerging market type of maybe a little bit weaker quality corporate governance, transparency type of businesses. Western Europe is liquid, it's transparent, and it's transparent accounting. I mean, so ESG is important. Now we have professionalized what we've done before. We have 3 colleagues which are responsible for the process. We have a proxy voting policy, for example. We are actively using our votes on behalf of our investors. So we are looking at the independence of the board. We are looking at the remuneration policy. And we know exactly what we own. We incorporated everything, MSCI, ESG data, into our trading system. So we know whether there are conflicts or red flags before we look at the stocks. And we're extremely green. We're extremely relaxed on ESG. There are no conflicts, no red flags, nothing like that.
And if we're thinking about the new sustainable economy opportunities that emerge out of sustainable investments, I mean, are the small caps well positioned actually to be that engine of innovation, to actually change and to provide services in a new economy as we do innovate and we take on board these concepts? I mean, would you say that the small caps are well placed to be that engine and innovate on the things that we need?
Absolutely. But before I start to elaborate on that, David, I'm of course significantly biased towards small caps, no doubt about that. But why? Why? The facts are on my side. The history, I mean, you can check everything I say. It's not that I invent anything. The future is uncertain, but go back the last 20 years or the last, whatever, 40, 50 years. The longer, the more interesting. 20 years, the prominent European indices, the worst was the Euro Stoxx 50. Actually, until early last year, it was down 50% in 20 years. So investing in the most widely or well-known European large and mega caps, you've lost half your money over 20 years. So long-term buy and hold is a good advice. I'm not so sure. If you own the right businesses, yes. If you own the wrong businesses, no. The MSCI Europe Stoxx 600, they have traded sideways for 20 years. Now they have finally started what looks like a new leg up. 20 years of sideways movement, and within that range, the Nasdaq and the S&P 500, they left this trading range in 2013. So, and the last 10 years, it has been a better investment on it if you're a passive investor, S&P 500 versus Stock 600. But the bull market in Europe, now I'm closing the loop to your question, is happening below the radar screen. We have a nice chart in our presentation where we show the relative performance of the MSCI Europe small versus large. And it's not a straight line. There are cycles in between, but basically it's going from bottom left to top right. It's outperformed more than 150% in 20 years. So the bull market is happening. And if you happen to know a good manager, there is a big alpha potential in that space. So if you find someone, we've always, over 3 to 5 years rolling, we've always been able to add an outperformance on top of that. So you have to look for the right stocks. There are large caps as well, no doubt about that. Some large caps are really good, but it's not 200. Maybe it's not so many. Yeah, there are more of those in the US.
Thank you. And the threat of inflation now is getting more. There's more momentum behind, more discussions around inflationary pressures. What threat do you think this poses to small caps if interest rates are rising? How do you see the inflationary impact of COVID being a temporary thing or something that might create longer term inflation trends? So how would you read that effect on the small cap sector?
And there are plenty of economists, strategists, and you can choose whatever you want to hear. Some of them say it's a temporary phenomenon. Some of them say it's here to stay for the next 10 years. I don't know. I don't know the future, but there are good arguments for both sides. Maybe the truth is in between. Certainly, everything collapsed last year. The oil price traded around zero. So there is a big part of that are base effects, certainly. But usually if the economy is booming, and it is booming as we speak, there is an inflationary pressure that is, maybe it's more or less at the peak. That's my personal opinion. That might be wrong, but interest rates have seen difficulties to move up over the last couple of weeks. We have seen economic disappointments. Most recently, when the newspapers report on boom, 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 stronger for longer, and I'm always skeptical if you read it in the news, because then it's digested. It's more or less. I think it's a good part of that inflationary or reflation has already happened. We're certainly not at the beginning, and this coincides with the rotation towards more cyclical names. A little bit of higher interest rates is beneficial for more value type of stocks because a bigger part of their profits is in the near term. And our stocks have a tendency of steadily growing. So that's a little bit from a NPV perspective, DCF perspective, a little bit of a headwind if you have higher rates. But don't forget, we are not into the 4 or 5% growth businesses. Our portfolio has a growth of an average 15%, and these are less affected. And some of our stocks grow 30, 40%. And as they are very profitable today, and not only in maybe 5 years, higher rates are not a game changer for them. Higher rates would be a game changer for bond proxy type of stocks, ex-growth, dividend stocks. They are really vulnerable. But again, very deep cyclical stocks, they have rallied significantly over the last 6 to 9 months. We're not into those typically. And that was the headwind I was describing before. So we have not outperformed, but we haven't lost 10%. We're on par with the benchmark, which has been extremely strong. So I think inflation is not a bad thing. I mean, go back to 2009, everybody was shaking and shivering. Deflation, that's the problem. And now we have a little bit of inflation. Finally, the central banks maybe have achieved what they wanted, a little bit of reflation to bring down the real value of debt. So I think unless it gets out of control, which nobody knows, that would be bad. But a little bit of inflation is, finally, we are there. Thank you. Yeah? And if you invest in the right stocks with pricing power, usually they use it as an excuse to increase prices even more. If you can increase your prices, you just do it. Yeah.
Thank you. And just looking at the technology sector, I mean, are European technology businesses which are very mobile inevitably drawn to the US for a deeper pool of capital opportunity to scale? What do you see of the ability to keep these companies within Europe? What do you see the support given, the infrastructure that's here? What's your perspective on that?
I don't see so much of a difference, David, on that, comparing Europe to the US in the small cap space. And now, I mean, everybody knows that the top 5 US tech companies, unprecedented strength. We don't have that in Europe. Maybe ASML, more than 200 billion market cap. But where we invest in these, let's say, sub 5 billion euro market cap stocks in software companies, IT service companies, some semiconductor critical components for the production of certain semiconductor components. These are not weaker than their US counterparts. Some of them have, I mean, the 2 healthcare companies you mentioned before, there's semiconductor companies in Europe, there's no competition. They may more or less control the market. And if they decided to stop producing and delivering, I think Apple would be not amused, because they would have to stop producing. There is a, the innovation culture in the US might be more vibrant, and they get larger, quicker. There's probably unlimited funding in the private equity space and the public space. That's probably an advantage. But you know, our companies don't need funding. We have on average in the portfolio there is no debt. Most companies have a big net cash position, so actually they're buying back their shares sometimes. So there's no need for big funding in the good ones. And these are global businesses. They are located. Corporate headquarters is maybe in the UK or in Switzerland or in Germany, but their business is in Asia and North America. And we own businesses in the UK. They are basically 100% North America or 2/3 Asia, and they are managed from the UK. Why not? And they show unprecedented strength in their margins, capital returns. But if you are an investor looking for 10 mega cap technology companies, probably you would have to look to China, and the US, and maybe 3-4 companies in Europe. But we're really small, as you know, and we find these innovations in the small cap space in Europe as well.
Okay, thank you. And Richard Brass mentioned that you're about to launch a new international microcap fund. Perhaps you could tell us a little bit more about this new fund. Where should I start? Actually, when you go back to 2009 and 10, when I was working at AGI, actually I was about to launch a European microcap fund. Why? Again, I've mentioned the size of the universe in Europe, more than 5,000 stocks. Nobody's basically looking at it. And that was, I was talking to MSCI for 2 years because I didn't want to launch a new fund without a real benchmark. So it should have been the real benchmark, which is MSCI Europe Microcap. So I was the one with MSCI starting the benchmark. We were the first ones. And then it was a big success and we had to close the fund. And we did the same at Berenberg when I started in October 17. We told the market we were going to close at a certain capacity. We've reached that in more or less 1 year later, then we closed it. It's a hard close. We're not accepting new money. And it's a fantastic
I think I'm really enthusiastic about that product still, because you're investing into these really unknown innovation leaders, which are growing double-digit and everything I mentioned. And now over the last couple of years, a lot of clients just approach us. Why don't you do it globally? I told them, we can't. We are closed in Europe, but we are working on a solution for you. We do it globally and exclude Europe, because you already own Europe. Our clients usually have a good investment in Europe in our own fund, or some others. Yeah. And now we're offering this, as you said, international, which is global ex-Europe, but only developed markets. It's roughly 1/3 US, 1/3 Japan, 1/3 rest of the world. And rest of the world is Canada, it is Israel, it is Singapore, Hong Kong, and Australia, New Zealand. So no emerging markets. Why not? The universe is sufficiently large. It's a few thousand stocks once again. And emerging markets are usually a little bit trickier. Corporate governance, transparency, liquidity. So we want to be a developed market portfolio. Yeah, believe it or not, David, we are, again, the first mover. We are pioneers. We have talked to MSCI for 1 year. We've established the benchmark together with them. It's a real benchmark, MSCI Global Microcap ex-Europe. So we're fair, transparent, and we are launching it most likely over the summer. So it depends on the authorities in Luxembourg when they approve it. So it should be there in 4-6 weeks, maybe. And again, we're enthusiastic, really optimistic over maybe the next 10-20 years. And this product is a special one. It's not the most liquid one. It's a limited capacity. We will have to close it at a certain capacity. But we have a similar opportunity set as in Europe, at least similar. It's a little bit larger, and the past performance was even better on a passive way. So I think there is no reason to be pessimistic on that. But it's not a product for everyone. People should be well aware it's a strategic investment for 5, 10, 20 years. That's not a product where you can steer your equity allocation every 3 or 6 months. You should be in there and just close your eyes.
Wonderful, very exciting times. Thank you so much for talking to me today, Peter, and we look forward to taking some questions now live in our webinar.